I wonder what you made overall of Kevin Warsh and his first press conference yesterday. Did he surprise you?
Well, it was a very interesting press conference. He stayed true to his vow not to really communicate his own views about policy or any sense of where policy might be going. The result of that was he really let the summary of economic projections do all the talking. And I think the markets really reacted because you had half of those projections, didn't include his projection, but half of those projections saying that inflation is going to be a lot higher this year, ending the year at 3.3% core, and that would warrant one or more rate hikes, and that's why you saw that big move in the 2-year. The other thing that was notable is that both in the statement and in his discussion, he really emphasized price stability and made it sound like a one mandate central bank. So those were the things that I think moved the direction of the market in a very hawkish shift. That's not actually what his comments, the sort of subtext suggested, but those were the main messages.
Well, so talk about his comments on what we just heard him say about financial markets receiving guidance from the Fed. In particular, I wonder if you have sympathy with the view that maybe the markets should be the one interpreting data on their own rather than interpreting the Fed's interpretation of said data.
Well, I think the difficulty here is that the market needs to, and the public need to understand not forward guidance in the sense that I think he is objecting to, which is suggesting here's what our action will be if inflation and unemployment come in at these levels, but at least a sense of how the Fed's policy is seeing current inflation, unemployment, and that gives both the markets and the public a sense of where policy might be heading. So what was interesting yesterday is he really didn't even want to provide a sense of what a lot of people call a reaction function. But his own biases seem to be sort of subtext in some of his comments. You know, he noted that half of the people who did submit projections didn't see a rate hike this year. He said there was no cruel choice between inflation and the labor market. So there were a few things that he said that might have pushed back in the other direction.
Well, and of course, as we consider what is said or what will be said going forward, we know there's going to be a whole task force on communications. There's going to be a lot of task forces under this new chairman. Has he asked you to sit on any of them? He said he was still making calls.
No. I think what was interesting about the task forces, we knew there would be a review of balance sheet policy. We knew there would be a review of communications. But I think what was interesting is the task forces on data sources, the task forces on the inflation framework, and the task forces on productivity all could be ways that even while emphasizing price stability, he tries to move the committee in a more dovish direction. So those were the areas that I think we just don't know where he's headed. But what we do know is that half of the committee is very worried about inflation, and that is consistent with the data we've seen.
So let's talk about that inflation framework, because he was asked specifically whether the Fed is going to be reconsidering the 2% target. And while he reiterated he's more focused on the 2, not what comes after the decimal point, he also said he sees no reason to change from 2% right now. Do you anticipate he could get there?
So what was interesting is that there are a number of things he said which suggest that he may not wish to stick with core PCE as the inflation target. He's talked about trim mean inflation. When he is now referencing a task force on the inflation framework, that too provides some wiggle room for potentially moving away from getting core PCE back down to 2%. And his comments on what's on the left side of the decimal point suggested that anything from 2.5 down to 2 might be acceptable. So all of those gave some suggestion that he might be looking for wiggle room, and that is not what we saw from half of the members who submitted projections where they saw inflation, core inflation, still at 3.3% at the end of this year, 6th year in a row of inflation well above target, new inflation pressures coming not just from oil, but now from AI, and saw the case for a rate hike or more.
Well, so on those inflation pressures, we obviously now have at least the beginnings of the reopening of the Strait of Hormuz via this memorandum of understanding between the U.S. and Iran. The U.S. naval blockade is now officially over, and Iran is supposed to allow the toll-free transit of vessels over the next 60 days. How quickly is that able to translate into lower energy prices that we have seen bleeding into other core inflation metrics?
So I think the question is, when will consumers really see it at the pump? Because that has a huge effect on consumers' perceptions of the economy. And right now, consumer sentiment is at rock bottom because they are so unhappy with high inflation. It will take some time. Buffers have really been used up during this transitional period. It will take time for production to come back online, for that Strait of Hormuz to fully clear. And so how much it still is going to move and lift core inflation, I think there's still some sense that core inflation could be given an uplift from oil for at least several months. And of course, we now have inflation coming from AI in electronics. We heard Apple's announcement. And so these are successive waves of inflation that are really likely to keep core inflation high through the end of the year.
I do want to ask you about AI, but the way you're talking about inflation right now lends me to believe you might have been one of those dots that sees a rate hike by the end of this year yesterday. Is that the case?
So I believe that conditions have really changed than we saw when the Fed started doing its easing cycle back in the fall. We've seen a tightening in the labor market. But what is really noticeable is that core inflation was actually rising before the oil shock, and we are now seeing new sources of core inflation from the AI data boom, and that's on the demand side. And so for all those reasons, given that we've had 5 years of above 2% inflation, I would probably be quite cautious about insisting that the Federal Reserve has to get inflation back to 2%.
So on AI, and we are actually going to speak with the chair of FERC up next on this program about data centers connecting to the grid, what it will all mean for ratepayers. Are you in the camp that sees AI firmly as inflationary because of higher energy costs, because of the actual infrastructure build out we are seeing, or that it eventually will be disinflationary because of increased productivity? Warsh's answer yesterday was, I have a task force for that.
So both, I think, are likely to be the case. It's clear today that AI is pulling forward demand for this just incredible data center build out, levels of investment that are equal to total fixed investment, non-residential, in past years devoted to data centers. And of course, that means chips, and those are chips that would otherwise have been going into electronics and other parts of the economy. So because it's really pulling forward demand, we're seeing a near-term inflationary impulse, and that is likely to lift core inflation, on the back half of this year. That's fully consistent with AI becoming a disinflationary force as business models really transform and the broader economy starts to really become more productive as a result of using generative AI.
In our final 30 seconds here, we're also obviously seeing AI help bolster the stock market and therefore the wealth of people who find themselves at the upper end of the K. What happens if these market gains start to dissipate at some point?
Well, AI is really driving the stock market. There's a lot of credit in the AI space. There's a lot of leverage. And so if we see a really big piece of data that suggests that revenues are not going to justify these valuations, you could see a pretty big correction.